Hello everybody, welcome to Paisa Live. We have today Rajit and Nandita from Side Ventures today. So first question is from you. The venture debt ecosystem in India has grown rapidly in recent years, right?
Yeah,
So what are the key factors driving its growth today?
I think the main factor today is that now a lot of founders and investors view venture debt as not just a runway extension tool, but they are funding specific use cases like capex, working capital, acquisition financing. So it's now being viewed as a more scalable growth kind of a solution, and people are understanding it's not meant for just one sector or one specific stage. It's more sector agnostic and stage
Yeah.
agnostic. So,
What are
Nandita, if you want to
you?
add on?
Yeah, and runway extension and to also prevent equity dilution. So, this is why a lot of folks use venture debt. And we are seeing that more mature companies are also taking in as runway extension until your IPO.
Oh. So my next question is from you, Nandita. Compared to global markets like the US, India's venture debt space is still evolving.
Yeah.
So what structural changes are needed for the market to mature the further?
Got it. So I think the penetration's increased. We are at a 9% penetration now compared to VD to VC, which was about 2 to 3% a couple of years ago. So that's improved, and we are tracking, US markets as well. So we probably see this as an inflection point, and in the next decade or so, we will be able to catch up.
Do you want to add
Yeah, I
anything?
mean, even on the supply side, right? 6, 7 years ago when we started, there were only 3 or 4 funds.
Yeah.
Now, when you look at India, on the venture debt side, there are 10 funds, and even more on the private credit side. The structures are also now more nuanced: securities, covenants, tenors. So yeah, I mean, it's reaching a stage where we should be at a level of 15-20% in the next 3 to 4 years as a percentage of VCP funding.
So my next question is to you, Rajat. With equity fund cycles becoming more volatile, are startups increasingly turning to venture debt as a strategic financing tool rather than just a bridge round?
So even when you look at our fund, right, 80% of the deals that we have done are in between two rounds. So venture debt as an asset class historically had a perception that we would piggyback on the last raise that the company has done. But actually, like I mentioned, it's basis use cases, right? When there is an increase in net working capital or when there is an increase in capex, that's when it comes in. It is useful for companies which are contribution margin positive. By that I mean that they are able to cover all of their variable costs, and companies that are able to service the repayments from the existing cash runway and future operating cash flows. So it is something which is relevant when there is a bullish phase in the equity market, but also during a bearish phase.
You want to anything add? Okay. So my next question is to you. Which sectors in India are currently seeing the strongest demand for venture debt and what is driving that demand?
So we saw in 2025 that the leading sector was fintech and closely followed by consumer. We also had clean tech coming in as a close third. So these are the top three sectors. In terms of where we see this evolving, we see B2B, AI, and clean tech picking up in the next year.
So last question is to both of you.
Sure.
Looking ahead, how large do you see the Indian venture debt market becoming over the next 5 years?
I think hopefully it continues to grow at the same CAGR. It was 37% if I'm
37% CAGR
for
from
about
2018 till
yeah.
now. Yeah.
But at least become 2.5, threefold, because more and more investors and founders are now accepting the asset class as a complementary tool. So
So in 2025, it was $1.3 billion.
Yeah.
It would probably touch about 4 to 5 billion in the next 2-3 years.
yes, thank you.
Thank you so much. Thank you.